Good evening, everyone. Welcome to the Loan Officer Training Series with the Mortgage Calculator. Give us just a second here to go live on all the different platforms and we'll get it started. We got the chat up on the screen there. Feel free to drop a comment there in the chat as you tune in. Tonight, we're going to be talking about how to use guidelines to structure your loan. So, probably Jose's favorite talking point here today. So, we'll go through that in a moment. Appreciate everybody tuning in nice and early. And it looks like we're live on all the platforms, so we'll go ahead and get it started here. And what we'll do is we'll take the chat off the screen for now, but go ahead and drop comments there in the chat. And you can also drop any questions you have in the chat as we go through here today. So, welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a lender that specializes in non-QM loans. And what we do every Tuesday, Wednesday, and Thursday evening at 7 p.m. Eastern on this show is an in-depth training topic for loan officers. Tonight's topic is going to be very basic, but very fundamental and important, which is how to structure loans using guidelines. So this is what Jose preaches to our team every day. So Jose, I'll let you go ahead and get into the presentation.
All right. How is everybody doing tonight? Thank you for joining yes, absolutely. Kyle, you have it right. Guidelines. I love guidelines. I mean, obviously, one of my initial job when I joined the financial industry was as a bank auditor. So you know how that goes regarding guidelines and policies and procedures. Uh, so in this training here, we're going to break it down, not so much individual option guidelines, but more stressing what is the thought process and how can you apply that to being able to properly assess your loan, properly assess the whole scenario, in a nutshell, how to be the best and most effective and efficient loan consultant. Right. In the end, we want to make sure we do the best job for our borrower to reach that objective in the most efficient manner for the borrower, which is usually going to mean a headache-free transaction with the lowest cost option that was possible to meet their objective. And by lowest cost option, not necessarily talking about your rate compared to somebody else's rate. I'm talking about the lowest cost option. Like as an example, today I helped one of our MLOs structure a deal. They came into our my live support Zoom room that I'm in for the team, and they were trying to figure out a borrower that was self-employed with a borrower that has W-2, and they're trying to put this investment property loan at an 80% loan to value, conventional, right? To the point that they have her with no income because the some prior attempt couldn't, someone else had denied that loan and they had tried to force it, not through the mortgage calculator, of course. They had tried to force it, square peg through a round hole, as I like to say. And what ended up happening is it got denied. Luckily, now we're in the picture helping them out. And luckily for them, I was there helping them structure the deal, the borrower's deal, because when we analyzed what was really there, you were looking at a conventional loan at an 80% loan to value investment. This is with a high credit score also, but the cost was like 3.8 points for the lowest cost option at an 80%, because the agency loans are really putting a high loan level price adjustment on agents on investment property loans and second homes. So uh, we're looking at that. I'm looking at that. Plus, we're looking at the fact that this borrower, who's now self-employed for at least 1 year, can't really, has having issues trying to get approved full doc agency. But we had the bank statement and W-2 combined loan where the borrower can have both loan incomes streams, or in this case, the borrower, we can now do that loan with the main borrower as a bank statement, the one that couldn't get approved full doc, and the co-borrower, who still makes excellent income, is now W-2. No 45 was, I mean, no tax return needed from anybody, just a W-2 transcript from the W-2 borrower and the 12-month bank statements from the bank statement borrower, verification letter from their tax preparer, preferably, and a letter of explanation for the fact that they are continuing a previous operation that they were as a W-2 employee, now as a self-employed borrower. That's a slam dunk. And best part of that scenario is that the interest rate is lower than the conventional loan at 80%. And the cost was also considerably lower for the non QM loan uh, when we were structuring like that as the deal that's going to close, as opposed to trying to force the square peg through a round hole. So that's just a little anecdote of what happened today and what we're talking about. Because if you come with a preconceived notion that the agency loan is always better, not necessarily the case all the time, right? That's why you need to properly assess the full transaction. So, first, a little bit about the mindset, right? Mindset here, determining the correct path is the key, right? You want to make sure that loan gets off on the correct trajectory. Why? Because as loan consultants, right, that's what we strive to be. That's what we train everybody to be at the Mortgage Calculator. Loan consultants, we need to gather the needed data, right? So we can provide the borrower with the most accurate assessment of their loan, and to be able to meet that objective, like I was talking about, in the most cost effective manner for the borrower. So I just mentioned the anecdote about what just happened today, where we got that loan and just totally shifted it, non QM that loan. And next thing you know, the borrower is saving 50% off of the loan discount fee and at a lower interest rate to boot. Mind you, the non QM loan has a 3-year prepay compared to the agency loan. But I mean, the agency loan was not going to be doable at a cost of like 4 points on the rate. Or they're going to have to come in with 25% down instead of 20% down for the non QM. So again, correct trajectory regarding wanting to be loan consultants, you build credibility, right? And the end result we want to meet, obviously meet or exceed our borrowers' expectations, right? Delight them with our service. Conversely, starting on an incorrect trajectory, I mean, you risk the delay in closing, not closing at all, or you close at the end finally after a marathon session, and the borrower is upset, never going to refer you a deal. That's not, that's one and done. That's not how you have longevity and, most importantly, sustainability in your loan officer career. So, talking about correct path, then we're obviously going to be considering agency or non QM, right? Agency, what do I mean by agency? Well, agency loans, FHA, Fannie Mae, USDA, VA, those are the agencies because the loans are sold through GSEs, which are pseudo governmental agencies, some of them more governmental than others, like Ginnie Mae, right? Ginnie Mae that buys FHA and VA, as opposed to Fannie Mae, which is conventional loans only, and Freddie Mac that are conventional loans only. The main thing about agency is homogeneous guidelines. Also, AUS, or GUS for USDA loan, which dictates documents required, as well as LTV, DTI, and credit score limits, because some of the options of the agency options have manual underwriting. Conventional does not; the others do. But at that point, the manual underwriting has usually much more restrictive LTVs, and much more restrictive credit scores, as opposed to when you get the approval via automated underwriting. Then you never know what's going to happen. You may be surprised, getting that 550 or that 520 score FHA borrower with only 20% down approved through DU, right? Not having to go manual underwrite. That means you have a 56.9 DTI possibility as opposed to 43%. So a lot of considerations, obviously, determining the correct path. If you're going to go non-QM, and these are points we're going to expand on now in the next following slides, is each investor, and this is key, each investor has guidelines specific to their organization and secondary market needs. And what I mean by investor here is not the investors you are financing, but the investors that purchase the loans that we originate, right? We don't keep these loans. We sell these loans to secondary market through different conduits. So each of those conduits has specific guidelines to the package that they're trying to put together. That's the cool thing about non-QM. Now, obviously, if there's a drying up of credit all of a sudden of liquidity, then at that point the agencies may have a little edge there, because if the funding dries up for non-QM and secondary, there's no money to lend. It's not like Fannie Mae, Freddie Mac, and Ginnie Mae that's going to be there. They'll tighten up like they did during the pandemic, but they'll be there. And then a real important note about non-QM, especially all our new MLOs out there, you're never going to have to run DU on a non-QM program, right? Especially DSCR. I actually had that happen because they are all manually underwritten. You pick the program that you want to submit for review, right? So no worries about what may happen through AUS, because it is all manual. And that's the beauty of non-QM. You are the filter, right? You are the DU. Now, breaking it down a little bit here, when we're talking about agency guidelines only vary due to investor or lender overlays, right? That's a critical component there. Now, you see that I put there the different URLs for Fannie Mae selling guide, Freddie Mac selling guide, VA guidelines, FHA guidelines, and USDA guidelines. Those are the raw guidelines, all encompassing. And then from there, what you have to worry about, or review, should I say, actually, worry if all of a sudden you get hit with this as an underwriting condition. And here's what we're trying to prevent, right? We're trying to prevent you struggling at the end because you were proactive in reviewing these things. At this point, you have to check the lender overlays to see what they may be for that particular lender that's reviewing the loan, and seeing if it's going to be approved, right? So that's the situation on that. Uh, but that's a critical component, because now if you are submitting something, for example, to FHA, let's say, doesn't have a credit score, minimum credit score requirement, but the lenders will. At that point, some will go as low as 500, some with the DU. If it gives it to you, they'll take it. Others say 550, others say 580, others say 600, 620. It's whatever they wanted to say in that respect. That's an overlay on the loans that they want to purchase, not a guideline change at the universal level. Let's put it that way, right? So that's really important, and that's why I reiterate here. Note that AUS has higher DTI limits, credit scores than manual underwrite. And again, conventional loans, Fannie and Freddie, do not have manual underwriting options usually that we can benefit from. So now non-QM guidelines, like I mentioned, are investor specific. So what I'm going to show you here in these two examples, I'm not going to break down any serious guidelines here because there's so many different scenarios. Remember, this is about the mindset. And in the following slides, we're going to break it down a lot more about, specific considerations to give you pointers, the main stuff that can really get you stuck. The main thing I'm showing here in this slide and the next slide is going to be just how the same exact program covering the same exact component. And here I'm basically breaking down one of the hottest segments of the market, which is short-term rental DSCR loans, and how to use that short-term rental income on your DSCR loan in a manner that's not going to get you hit with LTV reductions and the like, or just tell you at the end they can't even use it for whatever reason. So, because as I mentioned, guidelines are investor specific, not product specific. And I have this happen all the time. MLOs emailing, hey, on a jumbo loan, can we do such and such thing with a gift? Well, okay, which jumbo loan are we talking about? Prime jumbo, conforming conventional type jumbo, right? Or are we talking about a non-QM loan that's above conforming loan limits? So in this example here, right, as we review it, excuse me, you'll note one of the important highlights is that a lease agreement is not required. on even on a refinanced property, they don't ask you for a lease. They'll use the 1007, which is the schedule of market rent, or they'll use the lease agreement if you're trying to get a higher rent than the 1007 rent. Then they'll accept it, usually with some considerations, providing 3 months of payments and all that kind of stuff. Um, no, they'll let you use short-term rentals, and they apply a 25% haircut to the short-term rental income. They let you use Air DNA, and they'll use the 12-month average or 1007 if the 1007 is reflected as a short-term rental 1007. Right. So if no actual rent, then they use 75% of the short-term rental income indicators like Air DNA. Right. So that's that one there. Then example number two, again, this is short-term rental income. And first, you have to know the difference in how the DSCR income is calculated. This option requires a lease if using long-term rental. What that means is that, and I stop here to stress this because I've actually seen deals fall apart because of this. If you are using short-term long-term rental income to qualify the property because it qualifies the property, no need to use the short-term rental income. The that's like an aphrodisiac, right, of the investors. Then you would want to go to the option that this guideline pertains to, right? 1007 or lease, and again 1007 or short-term rental agreement, depending what you're using. But again, if you don't code it as short-term rental, it's right here, 1007. At that point, um, it could be short-term rental, but it could be fully furnished. Maybe the appraiser marks it vacant on the appraisal, but it's not vacant because that's what they do with properties that don't have a lease, right? If you don't provide them a lease, even though it's furnished, they're going to put vacant usually on the appraisal. And at that point, which one has an issue with a quote unquote vacant property on a refi? Most don't, some do, right? So that's what you got to look at. Are they going to ask me for a lease or not? This option right here, no lease required. They're not going to have any issue. There no reductions or anything like that. However, this one here lets you use the Air DNA on a refi if the property was just put into service, right? An unseasoned rental. So maybe you didn't use Air DNA for the purchase, but now you can use it when it's for the purpose of whatever you need to qualify now. So different options on how to do that, but definitely differences. For example, this one here, I think it has a different kind of a haircut on the short-term rental income, or it may depend on the vacancy factor. Okay, no, check this out now. A 40% vacancy factor must be applied to the short-term rental income from the comparable rent schedule. So if occupancy rate is 60%. So it really depends how the appraiser narrates the 1007. So a lot of different variables to consider. The other one across the board says 25%. So here you just want an extra narrative from the appraiser. So that's what we're really showing you the minutia here of breaking down the guidelines and how just missing one point of the guidelines there could cause you to get off trajectory and now all of a sudden be facing an uphill battle where you're at. Now I don't got time to switch programs, and now I got to be asking for exceptions. Is the exception going to cost money? Is the exception going to reduce the LTV? So a lot of things to consider. And again, this one requires a lease if using long-term rent. That's the big scenario, whereas the other one you can qualify using long-term rent. If it qualifies, easy peasy, because they don't require a lease. So now you saw the mindset, right? And how important it is to break it down like that. How important it is to realize that all programs in non-QM have different guidelines. They're all different. Don't generalize anything. You're leaving money on the table if you generalize, and if you don't just decide that, hey, I got to embark on the mission. These are my 3, 4, 5 options rate-wise that I like. Now let me start looking at the guidelines for these 5 options, and let me see which is the best one, because you may uncover while reading those guidelines that some of those scenarios pertain to your borrower, and now all of a sudden save your loan. So now we're talking about the importance. Now, here is where being the loan consultant really comes into play, right? Properly assessing all the transaction details, borrower details, I guess we would want to put it there, right? Um, Now, first, more transaction related here. Is it a purchase or is it a refinance, right? Now, both have seasoning requirements. Don't think seasoning requirements are just an issue for cash out refis. Seasoning requirements are a big time issue for a DSCR purchase, because if your borrower is buying a property that's a recent flip, and recent could be 30 days, within the last 90 days, or 90 to 180, 180 to 360. They have different categories. Each category has different requirements depending on the capital appreciation on the resale, right? Wow, you're like, wait a minute, I didn't realize that on a purchase, we were going to have to worry if the property is a flip, or else there may be LTV reductions and so forth and so on, or a second appraisal requirements off the bat, automatic, right? So note that situation. 90 the 90-day flipping rule for FHA loans, that's a purchase requirement. That's not a refi requirement. That's if your borrower is buying a property from a rehabber and they're buying it with an FHA loan, and the rehabber has been on title for less than 90 days, they cannot get into a contract on that property. The seller cannot enter into a contract on an FHA loan until the 91st day. That's the FHA 90-day flipping rule. So it has nothing to do with a cash out refi. It's on a purchase. More than one deal has been stung by that one there on a purchase. Again, now the easy one everyone knows about is cash out refinance using appraised value versus purchase price plus renovations when the property has less than X number of months of seasoning. Right. So we have 0 month seasoning available, 6 month seasoning, 12 month seasoning. So it really depends. Every deal is a specific deal. So on the DSCR, we have 0 month seasoning on a DSCR. If you've done some light rehab to the property after purchase and improved it, they'll give you the market value. But you got to have done some rehab. That's the main catch now on the no seasoning DSCR options. We used to have a lot of pure no seasoning DSCR options, but now they've tightened up that in giving us lower rates. They give it, then they take it, right? They've given us much lower rates. So in some cases, they've tightened a few things up. I think the one thing that's been tightened up has been the seasoning requirement, but we can still do it. No much seasoning. Um, is there a CDA or a second appraisal requirement on a purchase or a refinance? That's another big one. And again, that would depend on a lot of things. Read the guidelines. If it's a flip, if it's is one of the big ones, um, or just CU score over 2.5. Another reason possibly to have to get a CDA. So a lot of different things going on with that. Property type. That's a big one, right? Is it rural? Again, we have rural options for DSCR, for example, and we have rural options for primary. And I'm not just talking about USDA, or I'm talking about some products we have for like hobby farms, gentleman farms, and stuff like that. For producing farms, for actual farms, and uh, and DSCR, we have rural options also. May have some additional restrictions to consider, like the comps need to be a certain distance from the subject and all that kind of stuff, but that may be doable. Does it have an ADU? Is it one ADU or two ADUs? At that point, are two ADUs allowed? I just saw a deal fall through because they had two ADUs on a property. Normally, municipalities let you do one legally, doing more than one, or you may have the guidelines because of the, I mean, they know how the municipalities are. It's supposed to be a main and one. When it's a single family zoning, you'll see the guidelines normally won't accept a second ADU. Now, there may be one out there. I'm not saying there aren't, but normally they don't. So you got to then scour the guidelines and look for that option. Is it a non-warrantable condo? When it is, you're talking about normally something having to do with the budget or the finances, right? No reserves, that's the big one, or not enough reserves, don't meet the minimum requirement. Non-QM in some cases goes as low as 5%. And I'm not talking about a non-warrantable. And in some cases, we have options where they don't even check the budget; they just check the percentage of residents that are 15% or more delinquent. That's on a regular condo loan, non-QM condo loan for some of our options that we have. So again, you got to read the guidelines. They're all different, but the issues that bring up the item bring up issues is the budget, financial matters, and the percentage of investor versus owners. In other words, the rental units versus owner occupied units in the building is another reason that could make something non warrantable. Property condition issues is another big one. Let me tell you what, it's not the first time that we've received the email from the appraiser. They go out to the property and they're like, hey, what do you want me to do here? Do you want me to do this appraisal subject to, or do you want to call me back? Because basically this property is under renovation. There's no kitchen cabinets. There's no vanities. There's no toilets. Showers under construction. So then at that point, the MLO reaches out to the borrower. Borrower is like, hey, I was going to use the money to, complete the repairs. I didn't know that was going to be a problem. So with that being said, we do have programs for that kind of scenario. Renovation loans, we have some loans that only require an AVM. If the LTV is low enough, there's no interior property inspection, right? So at that point, just to note, I mean, it's not going to be an FHA loan unless it's an FHA 203K loan, which is a renovation loan. That's a different story, right? Or unless it's a conventional renovation loan or it's an investment property. We do have investment renovation loans, conventional for one unit properties. And then we do have our fixed flip loans that we discussed recently that are for the true investment investors with no prepayment penalties and no early payoff default penalties either. So that's a big one there that you consideration to discuss with the borrower, right? Got to ask that. A lot of people don't ask that, and they get burned. And then the more obvious, right? The credit. What's your score? Trade lines, or once you have the credit report, analyze what are the trade line requirements. Normally, at this point, we already have the data, the credit reports, and then now we are reconciling to guidelines. Now, DU does that for us automatically. But and should I say AUS and GUS, GUS for USDA loans, does it automatically for us. But in non-QM, remember, we are the AUS, so we're the ones that gotta put our nose in the grinder, review those guidelines, and make sure that, for example, in some scenarios where if you have 3 credit scores, some of our loan options do not review the number of trade lines nor anything. There's no open trade line requirements or anything like that. If you have the 3 scores, that underwriting model considers that your credit should be good and there should be something there that those 3 scores are there, and then we're going to look at the middle score, and that's how that's done. Another important consideration: housing payment history. There we're talking about, do you have a primary, as in a loan on a primary residence that you own? Are you paying rent? Or are you living rent free? Or do you have a primary with no mortgage on it? Well, on that primary with no mortgage, you're going to pay taxes, maybe insurance. So they're going to have you document the tax payment as your proof of timely housing payment in most cases. And the no rent scenario could be a little bit more difficult to overcome in some of these cases. So that's one of the things that you have to consider. Is it a true first-time home buyer, first-time investor program where you're living rent-free, or do they need to document for that scenario, first-time home buyer, first-time investor, some rent being paid, right? So those are points to consider. They're super important, especially on the non-QM and DSCR loans, and even on, believe it or not, one that just came to mind right now, conventional investment property loans. Did you know that if you are financing conventional investment property loans and the borrower does not have a primary housing expense of any type, you're not going to be able to use the 75% unseasoned rental income? At that point, zeroed out, because you need to have some type of a primary housing expense for agency loans, conventional, to let you use 75% of the unseasoned rental income. Some of you are probably saying, what? I didn't know that. Yep. That one can bite you, where. And then, of course, credit events, BKs, foreclosures, collections, and charge-offs. Now, don't be dismayed. We have options for people currently in a BK for at least 1 year, a Chapter 13. We have options for people just out of a BK non-QM. We have options for people 1 year out of foreclosure non-QM. We have options that you don't have to pay off the charge-offs as long as you can show reserves. So many different scenarios. Just properly analyze the credit event and properly reconcile it, and don't leave any stone unturned. Because obviously, if it's AUS is going to tell you if those charge-offs got to be paid off or not. I've had those investment property loans that they had $50,000 in charge-offs. They didn't want to pay it off, and on the purchase, well, not investment property, primary purchase, and but they gave a nice down payment, and they were able to leave those $50,000 in charge-offs unpaid. Same borrower though, we turned around and did it did it investment, ran agency, loan approval, because it's for different property. They bought two properties, a primary, refinance a primary or something like that, or bought a primary, bought an investment. But on one side, the primary obviously less risk in the algorithm. They didn't have to pay the charge-offs. The investment, more risk in the algorithm, has to pay the charge-offs. So then we pivoted to non-QM, did the transaction non-QM through one of the non-QM options that all you had to do was show reserves. Didn't have to pay anything off either. But see, that's the beauty of properly analyzing the guidelines, knowing the objective, and finding the lowest cost option for the borrower of those to meet their objective. And then other borrower details to consider. Right now, we're talking borrower residency. Where are they from? That's going to affect the loan type, LTVs, documentation requirements. Did you know that in a foreign national DSCR loan, there's no first-time investor or buyer consideration at all, and we have options where they don't even have to verify any primary housing expense in their country of origin. That's already important stuff. Income, borrower income. Now, we've had all these trainings lately, right? Are they salaried, hourly? Is there variable income, right? Overtime, bonus, commission, tips. Are there income gaps? Because, if it's more than 30 days, they're going to usually have to provide an LOE and possible additional docs to document what they were doing if it's a large gap, like 6 months. If they're self-employed, 2 years plus is usually required for most programs. But, big but, we have many options that will accept only 1 year. I'm doing the anecdote I just mentioned at the beginning here was the 1 year bank statement, 1 year in business, but doing that type of duties in their profession for many years. Full doc or alt doc bank statement, profit and loss, and then our very favorite, right, DSCR. But even on DSCR loans, like I mentioned earlier, when FHA loans, there's borrower and seller seasoning on title is really tight on those DSCR loans. You have to really be on point, but fear not. Like I mentioned, we have 0 month seasoning options as well as 6 and 12 month options that are available. And then assets, right? This is our last slide here. Assets, very important. Seasoning considerations: 30, 60 days. Look at the guidelines and see what they require. This is going to be the same on your AUS. AUS is going to tell you need 1 month bank statement or 2 month bank statements, or no reserves, no bank statement need to be required, provided, or maybe no reserves. That's usually on your refinance transactions that are they may not require if it's a very strong borrower. Now, sourcing of the deposit of the assets still may be required even if seasoning is not required, because you got to show where the money came from. You can't just show up with a bag of cash. Definitely not in the FinCEN states, like the areas like South Florida, right? Anything over $1 million, they're going to be, if it's $1 million or more in cash was used in the transaction, they are bringing out the magnifying glasses for those transactions. Gifts. Now, gifts, relatives, but they can also be from a close personal friend. You got to review the guidelines and see which allow that. And then, is it individual to individual gift? Because in most cases, it can't be LLC to an individual or individual to an LLC. It has to be person to person. And then reserves, be aware. Again, AUS is easy. Reserves are going to be underwriting on the findings, right? But in non-QM, there's going to be a matrix or matrices, more than one, with the different reserve requirements, and then a lot of different considerations. Some is just 3 months on the subject property and 6 months on certain LTVs or below certain credit scores, and that's it. Others are going to hit you per property 3 months up to a limit of 18 months or something like that. And so that can be, a hefty sum of money, and something and definitely a structure component that could make or break your loan. And then last but not least, one that gets missed: liquidity consideration when considering an asset. What do I mean by that? Well, some assets are more liquid than others. So checking account, saving account, money market, that's a pure liquid asset. That's 100% of the value you're going to receive. But in some cases, you may not receive 100% for a 401k and IRA or other retirement accounts. You may only receive 70% or 60%. Now, there may be cases where you do get that 100%, but you got to review all the guidelines to know. And those will be in non QM, basically, where you may find more flexible options on the liquidity consideration on the assets that you're presenting. So, a lot of things that we covered today. Real good stuff, though. I know that that's going to be stuff that's going to benefit everyone that's watching this and everyone that's going to watch the replay. I mean, a lot of these are a roadmap to, not getting stuck on your loan and trying to close loans. And I have loan officers ask me all the time, uh, you know, um, I'm looking at this loan transaction, and can such and such loan submission to such and such investor close in, X number of days, because we worry about underwriting turnaround time as being a factor, right? But then my reply to them is always, well, let's see. We go to the portal. Maybe that investor is advertising their underwriting turnaround time. Maybe for submissions it's 1 day, maybe 3 days. Maybe we've just had experience personally, and a lot of these we're getting same day submissions actually, and 24-hour submissions. Or we can relay, hey, personal experience recently on submissions. This is what we've had. But at the same time, then I'm telling them, listen, then the other components here is MLO proficiency, right? That's a really big one. That one is probably more of a factor than underwriting turnaround time. If you're turning in complete files, right? Turning in complete files, not incomplete files. Want to make sure it's not misheard. If you are turning in complete files, then underwriting turn time should be minimal. You should only have problems with multiple underwriting turn times if you just keep kicking the file back for resubmission multiple times because you're just piecemealing it, or just whatever you may be doing, and then they're obviously going to take a long time on your file, especially the third or fourth time that it comes for review. They're like, oh no, not this MLO's file again, right? So real important, that part there, especially so you can get all your files reviewed and close your loans ASAP.
All right. Thank you, Jose. Let's see here. Go ahead and drop any questions if you have them there in the chat. It looks like we have a question here. Not sure if I understand the question here. How can someone clear a partner savings plan for gift funds?
Yeah, I'm not really sure what is. I guess I'd have to look up if a partner savings plan has specific restrictions in the guidelines. I've never really reviewed a partner savings plan, but just note that it sounds like something that may have a little bit less liquidity than a regular savings plan. So you just have to see then what category it falls under and if you have to adjust it. Now, in asking how to clear, there's also other considerations to that question, which would be terms and conditions of the withdrawal, right? Are there any restrictions on the withdrawal type? Are you able to withdraw that money for anything you need with a penalty, for anything you need without a penalty, only under certain conditions, only under hardship, not for anything until you're 65? I mean, at all. So those are the factors that to be considered if you're going to use that asset, for example, as reserves instead of use that asset as an asset. If you're going to use it as an asset at that point for the transaction, then you're going to get credited for whatever is withdrawn from that account and deposited into your into your checking account or savings, or wherever you deposit it to close the loan. That's what that boils down to. So if you're actually drawing the money out, that's just the documentation, right? Provide the last 2 months or 3 months or 1 month, whatever they ask you in the approval, in the guidelines, showing the where the money was at, show the transaction of the money leaving that account and going into the account that's going to close, and that would take care of any sourcing requirement. And then the seasoning requirement, like I just mentioned, according to the guidelines, if they want 1 or 2 month bank statements.
All right. I do not see any other questions, so I think we can go ahead and wrap it up. But this was a great one here. Remember, we do this at 7 p.m. Eastern Time on Tuesdays, Wednesdays, and Thursday evenings with a new loan officer training topic. So the next time we will see you all will be next Tuesday, 7 p.m. Eastern, for the next episode of the Loan Officer Training Series with